Hello everyone, my name is Mayank and I'm a certified investment banker and you are watching the Quant. So in this video, we are going to break down one of the most powerful valuation tool used on a Wall Street, the discounted cash flow model. So we will understand what a company is actually worth, not based on a market noise, but based on a cash it can generate in the future. And yes, we would not just talk theory, we will build a DCF step by step and understand free cash flow, WACC, terminal value, and see how everything connects to the intrinsic share price. So, if you want to think like a senior investor, not just a trader, this video is for you. Let me ask you something. If the stock market disappear tomorrow, no ticket price, no flashing green and red numbers, so how would you figure out what a company's actual worth? Because here's the truth, the price and value are not the same thing. And that's exactly where the discounted cash flow model or a DCF comes in. So today I am going to show you how professionals actually value a business, not by a guessing, not by a hype, but by a focusing on a thing, cash. So most beginners look at the net income. So some look at EBITDA, earning before interest, tax, depreciation, and amortization. But serious investors look at a free cash flow. Why? Because profit can be adjusted, accounting can be flexible, but cash is hard to fake. Cash is a simple word. Cash generated from a operation minus capital expenditure. In a simple word, if I say it's the money left over after a business pay to run and maintain itself. That's the cash that can actually go to investors. So here the core idea from the DCF. A company is the total cash. It will be generated in the future, bought back to a today's value. That's it. So what do? We forecast, we estimate how much free cash flows of the company will generate over the next 5 to 10 years. And we will make an assumption about the growth, margin, and reinvestment. And this is where valuation become a serious because now you are not reacting to the market, you are building your own thesis. So now here the catch, $100 10 years from now is not worth 100 today, right? Money has a time value, there is a inflation, there is a risk. So we discounted those future and future cash flow using a something called WACC, weighted average cost of capital. So think of a WACC as a company risk meter. Like higher risk is indicates a higher discounted rate and a lower present value, and lower risk indicates a lower discounted rate and higher present value. So this step focus you to think about a risk properly, not emotionally. So here the something most beginners does not realize. If a DCF model 60 to 70% of a company's value comes from something called the terminal value, right? So that's a value of all cash flow beyond your forecast period, because business does not just for stop in after 5 years. We assume that they grow a stable long-term rate forever, and this one assumption can completely change your evaluation, which is why DCF is not a math. This is a discipline thinker. And so once we discount all future cash flows, we get something called enterprise value. That's the value of the entire business. But our shareholders does not own the whole pie alone. We will subtract the debt, and what's the left is the equity value divided by the numbers of shares. And now you have your intrinsic value per share. Now you compare that to the market price. If the intrinsic value is a higher, maybe it is a undervalue, and it is a lower, maybe it is a overpriced. So DCF is not a magic formula. It would not predict the future perfectly, but it focuses you to answer the hard question. How fast will this company are grow, and how risky it is, how much cash will it actually produce. And that's a discipline, and that's a structured thinking, and that is a separate real investors from the speculators. Because at the end of the day, the market set the price, but cash determine the value. Now that we are understanding the logic behind the DCF, how future cash flows are forecast and discounted, it is time to move from our theory to numbers, because valuation only become a real when you actually build it. So let's start with the calculation part for the TCF valuation for a XYZ company. And there is some assumptions like risk-free rate, market return, and market premium, tax rate, beta, and CAPM, and total debt, current market price, numbers of shares, right? There is a historical financials last 3 years. And now we calculate the FCFF for the projection. And there is some historical data last 5 years. Next, we find the terminal value. So there is two methods for the calculation. First is a Gordon growth. Second is the exit multiple method. So next we find enterprise value to equity value. So intrinsic value is less than to the market price. So that is indicates for a sell, and intrinsic value is greater than to the market price. So it indicates to the purchase, right? Suppose the value of the intrinsic is 46. So recommendation is a buy, just because the intrinsic value is higher than to the market price, right? But in this case, there is a recommendation for the sell. So if the IRR is greater than to the WACC, so that is a good investment. And IRR is less than for WACC, it is a bad. So in this case, it is value creation is a bad investment. Suppose IRR is 11%, so that is a good investment. So cost of capital is a low, so discounted rate is a low, and valuation is high, and risk and high risk WACC is a high, so valuation is a down, right? So next is a scenario analysis. So next is a comparable company analysis. So there is some assumptions. So this is the method to find a DCF valuation, and this is the investment recommendation for a valuation summary, right? So that recommendation is for the sell, not the buy. So this is the complete DCF model, and like, share, subscribe to contest.